Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Jason Les, CEO of RIOT Platforms, back to the channel to walk us through their Q2 earnings and outlook for the remainder of 2025. We've got a long list of questions. We're really looking forward to this one. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below if you're currently holding shares of RIOT and what you thought about their quarterly results. With that being said, let's get into today's interview. Okay, guys, that's right. Jason Les back on the program. Q2 earnings just came out last week. We're going to be going through that in today's presentation, along with a great update on outlook and strategy for the remainder of the year. So, Jason, some big numbers being thrown around in this 3-month period. We'll get into that in a second, but thanks so much for making the time. Great to see you again.
Yeah, great to see you guys, Bryce and Anthony. Looking forward to getting into the Q2 update with you.
Well, let's get into it then. So, in terms of highlights, I mentioned some big numbers this quarter from your company. We're expecting that from a few of the others as well. Can we get into some of the key updates or key highlight numbers?
Yeah, and I think that Q2 for RIOT was very big, both financially and strategically. And I will talk about the strategic points later. But financially, it was a record quarter for RIOT with nearly 500 million in adjusted EBITDA and 220 million approximately in GAAP net income. And a lot of this is driven by the mark-to-market gain that we've got on our Bitcoin. And this has been a part of RIOT strategy for really since the beginning, holding Bitcoin on our balance sheet, building that balance sheet strength, and giving shareholders exposure to these accretive assets. And that really came through in this quarter with the substantial gain that we were able to recognize there. In addition, another strong quarter of revenue as our operational performance, both in hash rate, continues to grow and our utilization hash rate continues to enhance. We achieved a 50% gross margin for a Bitcoin mining business for the quarter, which was a great result, especially considering we had a one-time tax assessment come in there that'll be reduced going forward. So regardless, still had a direct cost per coin of around $49,000 per coin. So another great result for RIOT, especially where you see Bitcoin trading today. In addition to that, it was a quarter where our hosting business finally got cleaned up. I'm sure we'll talk about that at some point. So those hosting losses were further reduced. And another strong quarter from a gross profit perspective for our engineering business. As you can imagine, the demand for switchgear and other electrical infrastructure is in super high demand. Our manufacturing division, ESS Metron, is incredibly well positioned and capitalizing that. And now they are at a record backlog of $120 million approximately. So that means there's $120 million in orders that are in the queue to be filled as capacity opens up. Little accounting thing. For engineering division, we recognize revenue as the jobs are completed, not as deals are signed. So that backlog represents all the work that's queued up that we can act on. And I'll tell you, the demand is pretty crazy. You tell someone that there's a multi-year wait, they just want to get in the line for this equipment. So really reinforces our vertical integration strategy, has led to continued improved financial results for RIOT. So we're really happy about this quarter, but we think with the moves that we're making, both in Bitcoin mining and our data center business and our engineering business, we're just incredibly well positioned for continued success here.
Yeah. And on those successes, obviously you've highlighted a number of those successes there, but equally during that quarter, there are a number of challenges. Can you talk to me about some of the challenges that you face and how maybe that those have now been overcome and we've got a sort of effectively what we'd like to say is a clean slate going forward? But give us a view on some of those challenges that you had.
So a challenge that RIOT has had for a number of years now was this legacy hosting business, and that was for these contracts that RIOT inherited with the acquisition of Whinstone US back in May of 2021. And there's been a number of pieces of litigation ongoing around that, and we've had capacity tied up, and particularly with the Rhodium contract, has been an ongoing drain on our financials. This quarter, we acquired Rhodium's assets and settled that litigation completely. And that was a key challenge that we overcame that accomplished three big things. One, it reduced the amount that we have to spend on legal fees to support that litigation going forward. Two, it cleared up that ongoing loss from the hosting business, clearing up our financials. And three, it gave us access to 125 megawatts of power that previously had to be allocated to Rhodium that we can now use to enhance our operations and improve the financial profile of that site. So very key challenge to overcome, as you can imagine, as a multi-year project to get that done. And that just gives us all the more assets and clarity to move forward on and continue to grow our business from.
Yeah. In terms of just a quick question on sort of gross margin, you mentioned the 50% gross margin. Talk about power costs. You've got two types of power costs. You've got the PPA agreement for the 345 megawatts at Rockdale, and you've got the market rate, which you've been utilizing at the Corsicana site. Over that quarter, what did you see from power in Texas, and how did it affect those two types of contracts?
Yeah, I think this is an underappreciated part of RIOT, even though we talk about our power strategy all the time. I think an underappreciated part of RIOT is the extent that we have built out this power management, power trading, and power procurement capability. And that's why RIOT consistently has one of the lowest power costs in the industry, always one of the lowest direct power costs per Bitcoin. It was just under 38,000 for Q2 of this year. So in our power strategy, as you noted, Anthony, we have 345 megawatts of power at Rockdale that we trade, that we participate in various demand response programs with. At Corsicana, we are primarily buying power from the market, although we do have power hedged there as well. And then we have our Kentucky operations that has some fixed component, and there's some demand response in there as well. So what that means is, while RIOT has procured these hedges at Rockdale at a low price that allow us to sell power back to the grid and lower our cost to mine, that is, we can never go lower than that price in buying power. And oftentimes in Texas, the power is very low. There's a lot of volatility in the power market there. You will see $5,000 per megawatt hour for power. You'll see negative $30 a megawatt hour for power, where you are getting paid to use power in those circumstances. So by having a blended approach, by having some power fixed, and by having now a substantial amount of power where we are buying just straight from the market with, that allows us to have a very diversified and well-executed power strategy that results in these lower power costs. In Texas, this summer, there's been less volatility than we've seen in summers. There's a lot more, especially solar generation that has come online. There's a lot more batteries online. And while there have been some high-priced hours, there have been not as much super high-priced for prolonged periods like we've seen in previous years. So not the same extent of power sales back, however, in the real-time market, but a lower cost than a lot of the hours of the year. We've also been very effective at strategically timing, making forward sales in the market. So what that means is, back in, let's say, March, we can take a view at how power is trading for June, for July, for August, or for September, and be strategically selling when there is panic in the market and that is driving prices up. As a result of all of these efforts, RIOT is doing excellent at its power strategy this summer, and you are going to see more details and results about that and the power prices that we're achieving as our monthly updates come out here through the rest of the summer months.
Awesome.
Okay. We're excited to see those, and a lot of companies now really starting to bolster their power strategy, and I know RIOT has really pioneered that, so great to see that's all coming to fruition. Now, another component there kind of dovetails into power is the curtailment. Another area you guys have been working on for multiple quarters, you've brought this up even into interviews last year, is your operational uptime, operational efficiency. Anthony and I were both pleased to see that came in at 87% for Q2. Now, it's difficult to ever get up to 100% with curtailment and some of these programs, but can you talk to us a little bit about what can we expect moving forward? Is this the new standard? Can we expect improvement from here, or what should we be looking at here?
You should expect us to continue to strive for operational excellence and continue to be able to achieve improvements from here. We'll talk about how that's measured, though. And we're really proud of this because I sat on this podcast with you guys a year ago and I talked about RIOT building out and focused on operational excellence. And that may have seemed difficult to materialize at the time with the results that RIOT was showing last summer. But as our operations built out, as we made the different enhancements and we upgraded where we need to, and we built our operations team out and brought in the right leadership to support that, we have seen significantly improved results. So when you see that 87% uptime, that is, as you noted, inclusive of curtailment. So if we're curtailing for high-priced hours, if we're curtailing to whether we're avoiding high prices at Corsicana or selling power back to the grid in Rockdale, or we're participating in the 4CP program, that takes that uptime or utilization number down, even though it has nothing to do with our operational capabilities. And there was, even though the volatility wasn't super wide, there was a meaningful amount of curtailment that took place during Q2 that brought that number down. So we don't have this number out for Q2, but if you looked at that net of power curtailment, you would see a number in the 90s. So we've made tremendous strides. I think we are amongst the most efficient operators at this time. And with the work that we're continuing to do, our goals are higher than where we're at right now. And we're going to continue to strive to improve this uptime, regardless if there's curtailment or not.
Yeah, we've seen that improvement over the last 12 months. In fact, I'd probably say that Bryce myself should be taking a little bit of credit from the time we visited Corsicana and was asking all those questions from the technical team there on how to deliver better performance. And since that period, actually, you've really gone in the right direction. So credit to you there. I think
it's a big project, to make these type of highlights. They're not overnight fixes. It's not like a button was switched off and no one got around to flipping the switch
in
back
fairness,
on.
it didn't happen overnight. But what we've seen is, and we've reported this, is it's that gradual improvement.
Yeah.
And last month you finished at top of the the year-to-date charts, ahead of Iron. So credit to you there. Obviously, moving just into the HPC side. And going through your presentation, one slide really caught my eye, which was slide 7, which is a nice picture of the Rockdale facility. And when I looked at that initially, I thought, is that Corsicana? It's got the water there, it's got the buildings there, it looks like it's got some diggers there, developing there. Are you able to say what's happening there with regards to any sort of development of that site? The slides in your presentation, but it looks like there's things are happening there, and you've got all those attributes that you'd expect a high performance compute site being made ready for. Can you? And now that in fact you've just explained, Rhodium have now left the facility, gives that extra 125 megawatts. You were never fully utilizing the 700 megawatts anyway at that location. Does it give you options now to see what strategy you can implement at Rockdale as well as Corsicana, which we'll talk a bit in a second or two?
Yeah. So, first, at both of our sites, we're always working to enhance them. Whether or not there's any growth going on, we're improving the professionalization, we're improving the safety. These sites came up very quickly, and in some cases, there's not even roads where there should be roads, because those were not the priority at the time. So what you noted in Rockdale, we built that retention pond there. That helps enhance the water supply at that site to service all types of applications. But to get to your question at its core, going back to slide 5 in our earnings presentation, you'll see a layout of how we think about our strategy. The strategy is to maximize the value of our megawatts and leave no stranded capacity. And what I talked about in the earnings script there was focusing on transitioning all of our power to the highest and best use over time. And the way the world looks like right now, and the way we believe it will continue to look even more so in the future, is there's an incredible demand for compute, which means there's an incredible demand for power and facilities to support that compute. So we see the ultimate goal of transitioning our power to data center use over time. However, you're talking about a substantial amount of power. With just the 600 megawatts that we're immediately focused on at Corsicana, would be one of the biggest data centers in the world right now. So it represents a lot to focus on right now. So we can't build 1.7 gigawatts and have that financed and good to go and constructed overnight. So we don't want to leave stranded power capacity. So we look across our portfolio, and there are times that we will look at enhancing or growing our Bitcoin mining hash rate in order to best utilize our assets until this transition can eventually be realized. So with the acquisition of Rhodium's asset and the settlement, we got this access to their operations. There's an additional 125 megawatts of capacity that was allocated to them. And what we saw as the lowest cost and highest impact use of that capacity in the near term would be to upgrade it and enhance it to increase our hash rate. So as a result, we have increased our year-end hash rate target to 40 exahash, and we now see ourselves achieving 45 exahash in Q1. This is a lot more measured growth in hash rate than you've seen from Riot in the past, where there are years where we're increasing our hash rate by 200%, 300%. You're looking at a 26% increase for 2025, and then approximately 10% increase right now for 2026. So a lot more measured growth with the focus on monetizing our megawatts, leaving no stranded capacity, and keeping this portfolio of power secured as we build out this data center platform and eventually transition this capacity therefore.
Okay, we'll probably cover a bit more about those machines that will replace what Rhodium have left behind for you. But in terms of Corsicana, obviously we had the additional packages of land being purchased there. Are you able to sort of like talk about any of the conversations that sort of like, or just in general terms, like and the expectations of actually, and maybe when do you expect to maybe announce something in the future regarding HPC and a potential partner? And is it more aligned to the co-location option, or would you be going down the route of maybe doing the on-demand sort of like strategy where you buy the own GPUs and utilize them at your own sites and manage everything yourself?
When we engaged Altman Solon to do a feasibility study of our Corsicana site earlier this year, one of the pieces that feedback that came back is the fact that the site could be enhanced if we had more land to work with. This was a potential hurdle to fully maximizing the site in a cost-efficient way. So we've acted on that pretty quickly this year. We've secured over 600 additional acres. We now have approximately 858 acres in or around our Corsicana site. That doesn't mean we need all that land, but it helps maximize the flexibility. So instead of having to do a 3-story data center, which may not be a bad thing to do anyways, but we want to give the most amount of development options possible by having this wide footprint. So we got that feedback and we acted on that very quickly. Building out this data center platform at Riot is our #1 strategic priority. So we have a lot of resources and we're checking off the boxes quickly to do that. I don't want to comment on ongoing discussions, what they look like, or who we're talking to or anything like that. But what I do want to make clear is we are approaching this with the mindset, with the goal of building a data center business. We're not trying to do like a single one-off deal and just lease our power away that doesn't get a ton of economics. Typically, we're open to that if the economics are right, but we don't see that as the best way to maximize the very valuable assets that we have. We have Corsicana and it's 1 gigawatt, an hour outside of Dallas, one of tier 1 data center market in the country. This commands a lot of potential value. So the way we see maximizing that value is building a data center platform, following a build-to-suit model, and building out data centers there to meet customer demands and lease these to high-quality tenants. So what we've been very focused on right now is, one, building out the team, which we've done with bringing Jonathan Gibbs on, a true data center veteran to lead our data center business. We've brought on a number of other veteran names in the space as well. And we are building out our basis of design that we can then go to market with and work with potential customers to then tweak to customize to what they're looking for. That doesn't preclude us from having discussions right now. As you can imagine, there's interest in this power. But these are the milestones that we are looking to complete before formally going to market to get the maximum value of what we see we have there. And the final question you asked, Anthony, about getting into GPU hosting ourselves, we don't see that as part of our strategy right now. That's something that we look at and think about. And if the market develops in a way, if it seems like there's a way that we can do something interesting there, that we will. But right now, our primary focus is developing these data centers and getting them leased out to high quality tenants, because that is the cash flow that the market is valuing high. 10, 15, 20-year contracts with blue chip tenants. These are the multiples. The multiples on that cash flow is what we're trying to achieve here.
So just a final follow-on question. The 600 megawatts at Corsicana, you've now bought additional land to support that. I mean, it looks like around about 2 acres per megawatt in simple terms, if you were to do the sums. I'm assuming, and you've just highlighted, I think in your last sentence there, you said clients. I mean, I've been to the largest data center in Europe, which was the Meta data center in Sweden. That's 150 megawatts. That's an enormous size. You've got 600 megawatts there. So the assumption would be is it's not one client that could go in there. It's maybe numerous clients that would go in there to fill that site.
What I would say is we're focused on getting this business off on the right foot and building it on a strong foundation. And what that means is starting it with a high quality agreement or a collection of agreements to which this platform can be built on. I think that Corsicana is very interesting because it does give a single tenant a growth pipeline that they can grow into. And we've kind of seen that with some deals done so far.
Yeah.
With Core Scientific and CoreWeave deals, with Applied Digital and CoreWeave deal. Well, these are all CoreWeave deals. Galaxy CoreWeave. They have a deal, and then they have an option for more capacity that it seems like they exercise. So the fact that we have 600 megawatts puts us in a very similar advantageous position. So I don't know what it would look like. It is possible a single tenant would want all of that capacity. It's possible that we fit an array of tenants in there. We are building our basis of design and building this platform so we can serve a variety of potential customers. Hyperscalers, yes, but also enterprise clients and also neo-cloud clients. We want to build the flexibility so we can be opportunistic and get the best possible results from what we have.
That's great. Yeah, we obviously want to try and get as much info as we can on the HPC side. Talking about building a platform here, you mentioned the acquisition of ESS Metron and how pivotal this has been to RIOT. Now, I saw in the earnings deck, you mentioned revenue, but the other component here, it's almost a two-sided coin. You've also recognized a tremendous amount of internal CapEx savings as well, I think around 18.5 million. So can you talk to us about how the synergies are not only helping you bring in revenue, but also helping your core business?
Yeah, when we acquired ESS Metron, it wasn't because we sought to get into we wanted to be an OEM. We wanted to launch a manufacturing business. We wanted the strategic benefits there. And we realized the strategic benefits in two key ways. One, Bryce, as you've highlighted, the savings on CapEx. And approximately 3 years since that acquisition, building out 400 megawatts at Corsicana and some of our expansion at Rockdale back in 2022, we've saved 18.5 million on CapEx. That's almost half of what we paid for ESS Metron to begin with. And also that has a vibrant and growing business that we're very excited about. The other part of it was internalizing this expertise. So RIOT is able to work with the engineers that we have in-house to design what we want to build, to tweak it when we need, to get great engineering feedback, and also service that equipment at the same time. That gives us great visibility and further control over our supply chain. We're not only seeing how the switchgear and power distribution centers and what the lead times and the design for that looks like, but we're seeing what the components that go into that look like as well. We have great visibility. This is going to be an important advantage as we build out this data center platform. And we have, as we've been in the industry talking to different participants, we've gotten repeated feedback of how this is an interesting differentiator. ESS Metron and now the servicing side, E4A Solutions, serve some of the biggest customers in the country, including the United States government and some very large data center projects. So having that expertise in-house is very valuable, and we believe de-risks and enhances our ability to build this data center platform.
Yeah. We mentioned obviously Rhodium before. Can you talk to us about the assets that they left behind? I think they had about 3 exahash of machines. Sort of what condition were they in? And you've talked about, sounds like you're going to replace those. I mean, we've seen a number of miners sort of stop growing, hash rate targets, Iron being one of them, Bitfarms being another one. You'd actually indicated at 38.4 you weren't going to grow any much more than that. Now it's sort of changed around. You're going to grow to 45 and complete that during 2026. Are you seeing that investment in new machines? Are you going to get that sort of return on that investment as we go forward? I'm looking at not just your results, but many of the miners' results at the moment. Once you start putting in the cost of machines into the cost, it's like they're not breaking even. And can you sort of give us an understanding of what, when you make these decisions to do this, what are you looking at that we're not looking at?
Yeah, we're looking at metrics like IRR, like return on invested capital, with our low operating cost structure, combined with our ability to procure machines at very competitive prices, to build cost competitive infrastructure, and where we see hash price at right now. We see a pretty quick payback period on investing in upgrading miners in that capacity, and also purchasing new miners to go in where there's some unused capacity there. So the breakdown, Rhodium had a whole array of miners, some new generation, some older. So some can be utilized, some could be upgraded, and there's some capacity that was just not being utilized that we're able to now build into. So this all goes under the theme, the strategy of leaving no stranded capacity and maximizing our megawatts. If we have a cost efficient structure where we can monetize those megawatts and get ROI on those miners quickly, we have the balance sheet to be able to act on that. And that's what we're doing this year. We're funding off our balance sheet, using that cash on hand to procure new miners, to upgrade some of the miners left by Rhodium and bring new hash rate in there. And that is going to increase our overall hash rate. That is going to give us the benefit of economies of scale and allow us to lower our direct cost per Bitcoin and hash costs. All other things remaining equal. And then finally, as I highlighted with Rhodium, it removes that overhang of that previous litigation and hosting loss.
So in terms of, it's really about machines, not about infrastructure. The infrastructure is there, so very little to build out infrastructure.
There's some infrastructure being built. The infrastructure left could not necessarily accommodate all of the 125 megawatts. So there's some new infrastructure being built out to support that. But once again, this is capacity that was immediately available to us. This would otherwise be stranded, unutilized power. And in a time when something like this it is scarce and the economics look good, we made the decision to move quickly here and get that power monetized with hash rate as soon as possible.
Yeah, makes sense. Now we've talked about strategy, some of the ways you've differentiated yourself from competitors, your go forward plans. What is one misconception that you hear about Riot or you see on social media that maybe we could clear up here, Jason?
Well, first, I mean, I think it would be helpful for people to understand kind of how Riot got here and where we came from. We are in a great position today. It's not something that was handed down from us. It took many, many years of work. The company was in a very bad position back in 2018. There's a number of financial, legal, regulatory challenges that were truly crippling the company, and the company's days were numbered. We're at about $1 per share, a $20 million market cap. and didn't have any of the assets that we had today. At that time, the board took a good amount of leadership in turning the company around. That included myself, our executive chairman, Benjamin Yee, and then another director that we had at that time. And what we've come from that point 7 years ago today is quite remarkable. So I share that to just highlight that this has been a ground up effort. It's difficult to be a founder of a public company unless you were there from the very beginning. RIOT has had what is now called RIOT was a number of different versions going back 20 years to 2002. But we stepped in at the time because we saw the opportunity with Bitcoin, and we built this up to what it is today. And by focusing on the vertical integration strategy, we're able to now benefit from all the power that we have and build this data center platform that we're incredibly excited about. That is a misconception that we wanted to, or something that we wanted to clarify on this earnings call, that we were not looking to just take 600 megawatts, find the quickest possible deal to do something and leave a ton of value on the table. We are approaching this to build a data center platform. And this isn't just being done by the same team that has just been doing Bitcoin mining. While that, I think, gives us a lot of advantages in the data center space, we have brought in a whole new team to lead these efforts. So we have seasoned data center professionals, and we are bringing in more all the time that lead and comprise our data center group and give us the expertise and I guess the presentation that hyperscale enterprise large data center customers are used to expecting. So we really wanted to make sure the market investors understood what we were doing here. It's not to try and just do the quickest deal possible, get a little something in and move on. What we have in terms of power capacity and where it is incredibly valuable. And we see the path to maximizing that value as building out this data center platform. We're talking about the milestones that we have on our roadmap to complete in order to realize that vision, in order to succeed at that goal. And we are going to continue to update the market as we knock off those milestones one by one. And in 7 months here, 6 months here, we've done quite a bit. And I think you should expect to see very meaningful progress along this path over the rest of this year and into 2026 as well.
In terms of capital expenditure, obviously we've got a very good slide in the deck, which we'll put on the podcast. It's, I think, slide 14, which covers all you're expected for this year. Obviously, we've been talking about things that are going to be happening in 2026, 2027. In terms of levers for raising capital, I mean, you used a convertible note last year. You've obviously utilized the ATM over the last few years, and you've just talked about how that company's grown from. I remember the time when it was, not that far away from 20 million, and today we're sort of like, hovering around the 4 billion mark today. And that was significantly higher at the beginning of last week. I think it was 5 billion beginning of last week. So things can change rapidly. But what other levers are available? And actually, with that massive hodl that you've got there, is there any expectation you could also use that to raise capital? I mean, there's some ingenious ways of people are coming out with now using their Bitcoin to do that without actually sort of like giving it totally away, if that makes sense.
That's right. We have built our business in a way where we have multiple options that we can pull on in order to finance our business. And different parts of the business are financed differently. One of the very attractive things about building out this data center business is the project financing, the development financing that's possible there with the right deal and right structure that you're not going to get in something like Bitcoin mining. Bitcoin mining's largely been equity financed for a lot of miners out there, or using convertible notes or borrowing against Bitcoin. RIOT is in a great position for financing our business because we have aimed to maximize the amount of levers that we have. One, we have a significant access to capital markets globally, and that has allowed us to use an ATM when advantageous. Although you've noticed that our ATM usage has been much more measured this year, and that's because we've been focusing on other levers that we have. We have the Bitcoin from our monthly production. We've been selling monthly production in recent months. That helps to fund operations, and that helps to fund growth as well. That does not mean we are always going to sell monthly production. It is a lever that we are using at this point in time. The other key lever that we have is our Bitcoin balance. We have built that up to now over $2 billion. When you combine cash and Bitcoin, Riot's sitting on nearly $2.5 billion of liquidity right now. So we are in a great position to finance anything we do. But building up this Bitcoin balance has been part of our financing strategy. And what Riot did earlier this year is take on approximately $200 million of debt collateralized by our Bitcoin. We're able to get a very competitive rate there and get the benefit from that without having to sell that Bitcoin. As our Bitcoin balance increases over time and the value of Bitcoin and therefore the value of that balance increases over time, that is a growing pile of which we're able to utilize to finance our business without issuing any equity as well. So we have a ton of great tools here. We also have equity investments that we're able to pull on. And as a executive team, we are always looking at all the options at our disposal and choosing what is the most accretive option to use. And we're fortunate to be in this position where we are not limited. We have great options to choose from all the time.
Kind of an extension of that one, Jason. You talk about some of your equity investments. You guys held at 19.9% of Bitfarms. We've seen that position come down in recent months to around half, around 8.3%. Can you give us any update there on what the plan is with that lever specifically? Do you intend to continue to draw cash from that investment? And kind of as a part two on M&A overall, or a kind of a macro theme, can we get an update on that as we go into the back half of 2025 as well?
So that is one of the levers that we have to pull on, as you noted, Bryce. I can't really comment what our go-forward strategy will be around there, but that is a lever that we have pulled on to finance growth with our business and avoiding needing to issue as much equity in order to do so. As far as the broader M&A landscape goes, we're not super focused on Bitcoin mining M&A right now. We've done some deals in the past. If we were to do M&A right now, it would probably be something around securing more power. That way, we would have something that could be utilized for either Bitcoin mining or for the data center segment. Our strategic focus and priority right now is building out this data center platform. So we're not as focused on M&A right now because the data center is a priority. But if an opportunity came up, it would probably be something more around in the flavor of something that would give us more power in order to enhance that platform further.
We're getting close to the end of the conversation. Obviously, one of the biggest talking points, it's still in social media land, is stock compensation and salary packages, and there was highlights of directors on the same page as directors' earnings for the likes of Nvidia and some of these mega companies there the other day, in which really, I look at the company side by side, I just don't see the correlation there, but packages seem to be getting quite significant. Can you sort of explain some of the myths that people are sort of looking at in terms of stock compensation? You've highlighted that you're looking to reduce stock compensation in 2026. Can you talk about how that decision came around there and whether that was impacted by a lot of the sort of social media position on this against a number of miners, not just Riot platforms?
So first, when you look at equity or executive compensation disclosures, it's not as simple as this is an amount that was paid to this executive. There's different rules that govern how those numbers, how those tables are laid out. So sometimes people can see a big number and be like, oh, this guy or gal got paid whatever amount, when really that was how the equity is accounted for, but something that anyone has actually earned or received. So for Riot specifically, when you look at the level of compensation, that's really been driven by a large performance equity award that was made in a previous year. looking at our financials, accounting rules are what require us to expense that award, and we have to expense the maximum amount that can be earned in that award over the possible performance period, even though it has not been earned. That's what you see in our financials as a stock-based compensation expense. It's not new awards being granted all the time. It's not that award being paid out. It is really just accounting rules that drive the schedule of how that award is expensed. This award was a one-time grant. It's not a reoccurring amount. And the performance award for this specific award that we're talking about runs through mid-2026. So by the performance period simply ending and that expense schedule ending, you will see stock-based compensation come down considerably. This equity award that we're talking about here, another, I think, misconception about how executive compensation is done that we see out there is these decisions are made by an independent compensation committee and working with an independent compensation consultant. And oftentimes there's different rules to how these awards are earned that make them quite challenging. And oftentimes, in the case of our awards, are tied to meaningful overperformance versus the market. So we often earn these performance awards when our stock price is, and only if our stock price is outperforming the market or what we're being measured against. So it's really tied to shareholder value creation and not paying out when shareholder value is not being realized over those performance periods. This performance award that I've been talking about, this is managed by an independent compensation committee. And I highlight that our compensation committee was refreshed this year, and there's now substantially new membership of this committee. Other thing I'd highlight about RIOT specifically is I've talked about how the stock-based compensation expense works. It's not new awards being made. It's the expense of a prior award. I have not received any new equity compensation this year, and I do not expect to receive any equity compensation this year. My goal is executing on our strategic plan, continuing to position RIOT to report improved financial results, build out this data center platform, and the objective of doing all of that is, of course, to realize the shareholder value creation reflected by an increased RIOT share price over time. And that is how I am ultimately rewarded.
Thank you, Jason.
Yeah, appreciate the context there, and glad to hear there are some steps being taken, hoping that RIOT can kind of set the trend here and others may follow. So that's great to see some tangible moves there, Jason. As Anthony said, we're getting close to the end of the conversation. We wanted to give you the opportunity to close out. I know we've covered a lot of ground here today. We really appreciate the open, honest, transparent communication. And if there's anything else maybe you wanted to throw in or that we haven't touched on here today.
Yeah, RIOT is very focused on maximizing the value of the assets. I've talked about how our goal is to monetize our megawatts, leave no stranded capacity, and maximize the use of all that capacity. We are in a great position with nearly 2 gigawatts of power today, 1.7 gigawatts of that in premier data center markets. We have an extremely strong balance sheet with almost $2.5 billion in liquidity between Bitcoin and cash. And we have an incredibly strong team, particularly now the new data center team that we're building out, led by Jonathan Gibbs, data center development industry veteran. So we are in a great position to succeed, and we are doing everything possible to build out this data center platform as quickly as possible. But we want to be measured, and we want to take the right steps. We want to make sure that we maximize the value of these megawatts. We maximize the value of everything that we have. So we're incredibly excited about the position that we're in. Bitcoin mining is an incredible tool to sourcing new and securing power that we have. We're doing that in order to help finance our business and enhance our financial results as this platform is being built out. And eventually, we believe there is a great opportunity to transition this power into data center leases over the long term. That doesn't mean that's the end of Bitcoin mining. As I've said, Bitcoin mining is an incredibly powerful tool, and we will utilize that to find new power capacity and build our pipeline out further. Our strategy involves Bitcoin mining, data centers, engineering, and our balance sheet. I encourage everyone to look at our recent earnings deck and watch the recording of the earnings call if you can, and understand how we're thinking about this and how all of these pieces are moving together to enhance and create new shareholder value over time.
Awesome. Exciting times. We look forward to having you back on the podcast soon to hear about these developments. Once again, thank you so much for making the time today, Jason. If you guys have any additional questions we didn't get to, leave them in the comment section below. Hit the like button. Feel free to subscribe. We'll see you back here tomorrow.